Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Bitmine Immersion Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's unpack this. We're looking at a scenario today that sounds, honestly almost like a financial heist, but it's happening right out in the open on Wall Street.
Yeah, it really does sound like one.
Right. I mean, imagine a publicly traded company that used to be just a traditional crypto miner. You know, the old model, massive warehouses, thousands of computers generating insane amounts of heat, basically just solving complex math to earn rewards.
The standard hardware and electricity play, yeah.
Exactly. But recently they realized that just mining assets wasn't enough. They have completely flipped the script. They've basically shut down the traditional approach and transformed themselves into this aggressive digital asset treasury. And their new goal, instead of digging for gold, they're building the world's biggest vault of gold and selling tickets to the vault at a premium. They literally want to capture 5% of the entire global supply of Ethereum.
It's a radically ambitious pivot. I mean, based on the SEC filings and the market data we're analyzing today, it is entirely re-rating how the broader market values them. They're no longer just a proxy for hardware costs.
No, not at all.
Right? They've engineered themselves into a pure financial accumulation machine.
So for you listening, whether you're heavily invested in digital assets or you're just, trying to understand these huge macroeconomic shifts, our mission today is to figure out the actual mechanics behind the strategy.
Because before we can talk about price targets, you have to understand the underlying business model.
Exactly. We need to look at how they're acquiring this much Ethereum, the hidden catalysts on their balance sheet, and obviously the structural risks, because you can't have an accumulation machine without some serious risk.
And the foundation of that model is purely focused on accumulation. Right now, as we sit here today, they already hold 4.661 million Ethereum tokens.
Which is just, to put some context around that number for everyone, that represents 3.86% of the total global supply of Ethereum, just sitting in their treasury.
Exactly. And management has publicly stated their ultimate objective is this concept they call the alchemy of 5%.
The alchemy of 5%.
Yeah, they want to organically accumulate and hold a full 5% of all the Ethereum in existence. What's truly staggering, though, is the speed. They are already 77% of the way to that target, and they've done that in just 8 months.
Wow, only 8 months. Which, that naturally brings up a massive point of skepticism. I imagine you, listening right now, might be scratching your head. If I'm an investor and my thesis is that Ethereum is going to appreciate over the next 5 years, why wouldn't I just buy it directly?
Right. Why bother with the stock?
Exactly. Why buy shares in a company whose only job is to buy Ethereum? It feels like adding an unnecessary middleman. Wall Street doesn't just hand out free money, so what is the actual advantage here?
What's fascinating here is the underlying financial mechanism they use to build wealth for the shareholder. It's a corporate finance strategy known as net asset value, or NAV accretion.
NAV accretion.
Right. This is the exact playbook MicroStrategy used so successfully for Bitcoin, but Bitmine is aggressively applying it to Ethereum. To understand why it's better than just holding the asset, we have to look at the math.
Okay.
When you buy Ethereum directly, your return is purely 1-to-1. If Ethereum goes up 10%, your portfolio goes up 10%. But Bitmine is using the public equity markets to create this compounding financial flywheel.
Okay, let's break down the plumbing of that flywheel. Walk us through how this accretion loop actually functions in the real world.
It starts with leadership in market trust. Bitmine is led by Thomas J. Lee, a highly prominent Wall Street strategist. Having someone with that level of institutional credibility means the public market trusts the operation.
Right.
Because of that trust and the demand for easy digital asset exposure, the market is willing to pay a premium for Bitmine stock.
Meaning, the stock trades at a price that is actually higher than the raw value of the Ethereum sitting in their vault.
Precisely.
Yeah.
Let's use your vault analogy. Imagine a company whose only asset is a vault containing 10 gold coins, and each coin is worth $1. In a perfectly rational market, the company should be worth $10.
Makes sense.
But because investors trust the management and want an easy way to trade gold on the stock market, they're willing to value the company at $15. The company is trading at a 50% premium.
Right, so the market is basically paying for the convenience.
Yes. And here is where the accretion engine kicks in. Because the stock is trading at a premium, management can issue new shares to the public. They take that newly raised cash and go buy more gold coins, or, in this case, more Ethereum.
Wait, let me make sure I'm following. If they issue new shares, doesn't that dilute the ownership of the existing shareholders?
Usually, yes.
Yeah, printing more stock is almost always a bad thing for the people who already own it.
It's a bad thing if you sell the new shares for less than the underlying assets are worth. But because Bitmine is selling new shares at a premium, they're taking in more cash per share than the current underlying value per share.
Okay.
So when they use that cash to buy Ethereum, the total pie grows faster than the number of slices.
I see. So the total amount of Ethereum they just added to the treasury adds more baseline value to the company than the dilution took away.
Exactly. It grows the net asset value per share. Every single time they execute this loop issue stock at a premium, take the cash, buy more Ethereum, the foundational value of every single existing share goes up. You just don't get that compounding mathematical growth by holding a token in a digital wallet. You're buying into an active accretion engine that is constantly raising the floor price of the stock.
That makes a lot of sense on paper. It's a brilliant way to leverage market enthusiasm. But I mean, to run a financial flywheel of that magnitude, especially in crypto, which is known for violent volatility, you can't just operate on fumes.
No, absolutely not.
You need an incredibly sturdy foundation, which leads us perfectly into the analyst reports covering their balance sheet. Because if you're going to build an engine designed to buy 5% of a global network, you need to know how thick the walls of the treasury actually are. And the numbers here are astronomical. Their total crypto and cash holdings currently sit at $11.0 billion.
Billion with a B, yeah. But the headline number isn't actually the most important metric. Analysts look at the composition of that balance sheet. Out of that 11 billion, 1.1 billion is held in pure unallocated cash.
That 1.1 billion is essentially a massive financial shock absorber, isn't it?
It provides absolute structural security. In the digital asset space, we frequently see violent 20 or 30% drawdowns over a single weekend.
Oh, yeah, all the time.
When a crash like that happens, companies that are over-leveraged or cash poor are forced into fire sales. They have to liquidate their core crypto assets at the worst possible time just to keep the lights on.
But with over $1 billion in pure cash, Bitmine can just sit on their hands during a crash. They never have to sell a single token of Ethereum.
Correct. And that structural security is a major reason why the stock enjoys such massive liquidity. Bitmine is currently the 101st most traded stock in the U.S., processing $1.2 billion in daily trading volume.
And that volume isn't just a vanity metric. If I'm connecting the dots back to the accretion loop we just talked about, you can only pull that off if there's a massive pool of buyers waiting to absorb those new shares.
Exactly. High liquidity is the oxygen for the NAV accretion engine. It facilitates capital raising on incredibly favorable terms. A major institutional fund is comfortable taking a massive position because they know with 1.2 billion trading daily, they can exit without causing the stock price to completely collapse.
It's a massive liquid on-ramp. But as we were digging through these filings, there was one specific line item that really caught my attention. Alongside all that Ethereum and cash, Bitmine holds $95 million in a digital asset called ORBS.
Right, ORBS position.
Right. And the sources indicate that ORBS provides indirect exposure to OpenAI, which feels like a major curveball. How does a company whose entire mission is to corner 5% of the Ethereum market end up holding an OpenAI Moonshot catalyst?
It's, a highly strategic diversification play. To understand it, you look at the narratives driving institutional capital.
Yeah.
On one side, you have the financialization of digital assets, which their Ethereum treasury covers beautifully. On the other side, you have AI.
But how does a crypto token give them exposure to a private guarded AI company like OpenAI?
It's actually quite common in decentralized tech. ORBS operates as a blockchain infrastructure network. These types of networks often form strategic integrations or establish grants that directly tie their success to the growth of major AI players. So the ORBS token itself acts as a financial proxy.
So it's essentially a venture-style proxy bet wrapped inside a digital asset.
Exactly. And look at the scale. They're allocating $95 million to this. In the context of an $11 billion treasury, that is less than 1% of their total assets. It's a tiny risk footprint, but it embeds a massive asymmetrical catalyst.
Right, because if OpenAI announces a traditional IPO or drops a revolutionary new model, networks like ORBS experience a sympathetic re-rating.
Yes, and it attracts a completely different class of investor. Suddenly, Silicon Valley AI speculators are looking at Bitmine stock.
Which drives up demand, increases the premium, and feeds the accretion loop even more.
It's a brilliant way to sprinkle a hypergrowth tech catalyst on top of their core strategy without taking their eye off the ball.
Okay, here's where it gets really interesting. We have the accretion loop, the cash buffer, the AI diversification, but honestly, an $11 billion treasury is still inherently passive. You're just sitting there guarding the vault. But Bitmine isn't just hoarding Ethereum like a dragon. They're putting it to work.
If we connect this to the bigger picture of how digital networks operate, this is the most critical difference between Ethereum and Bitcoin. Ethereum operates on a consensus mechanism called proof of stake.
Let's make sure we clarify the plumbing of proof of stake for the audience, because I always hear people say it's, like earning interest in a bank, but that doesn't really explain what's happening behind the scenes.
Right. It's not a bank paying you yield from loans. In a proof of stake network, the network needs computers to verify transactions and secure the ledger. To become a validator, you have to lock up or stake your own Ethereum as collateral.
Like a massive digital security deposit.
Exactly. If your computer verifies transactions correctly, the network rewards you with newly minted Ethereum. If you act maliciously, the network penalizes you by destroying a portion of your locked collateral.
So by staking your Ethereum, you're actively performing the accounting work for the global network and getting paid a yield for your labor and collateral. This is like taking a mattress stuffed with billions of dollars and transforming it into a high-interest, compounding banking infrastructure.
That's exactly what it is. And on March 25th, 2026, Bitmine officially launched the Maven staking network. This is a massive operational shift. They didn't just hand their Ethereum to a third-party provider to earn yield. They built their own proprietary institutional-grade infrastructure.
And their goal is for Maven to become the largest Ethereum staking provider globally.
Yes. And they aren't just testing the waters. Right out of the gate, they have over 3.1 million staked Ethereum tokens running through this system.
Which in dollar terms represents roughly $6.5 billion actively generating yield right now. That instantly validates the entire Maven infrastructure thesis.
It completely changes the valuation model of the stock. Based on the analyst reports, Bitmine is no longer a passive hold company. They are an active yield-generating infrastructure business. And because they own the physical and digital infrastructure, they don't have to share the yield with a middleman.
So their profit margins are exceptionally high.
Very high.
And management has signaled plans to expand Maven to provide services for other proof-of-stake chains, too. They're basically trying to build, like, the Amazon Web Services of crypto yield.
The analyst consensus argues this creates an undeniable competitive moat. Smaller competitors just can't replicate this scale. You can't just spin up a $6.5 billion staking operation overnight.
So what does this all mean? We have a massive balance sheet, a $1 billion cash shock absorber, an accretion loop, an AI catalyst, and a $6.5 billion yield engine. It's no wonder analysts are rating this a speculative buy. With price targets between $50 and $75 over the next 6 to 12 months, it sounds bulletproof. But, exactly, we have to look at the market tape. Recently, this stock took a sharp hit. On March 26, it dropped roughly 6% in a single day. If this company has built such a brilliant infrastructure, why does it plummet the second the broader crypto market sneezes? Aren't investors just buying a highly volatile leveraged tracker with massive dilution risks?
This raises an important question. It's exactly why the word speculative is attached to that buy rating. You are absolutely right to point out the volatility. The data shows Bitmine exhibits an extremely high beta to crypto prices.
For anyone unfamiliar, explain what high beta actually looks like in practice.
Think of beta like a rubber band, attaching Bitmine stock to the price of Bitcoin and the broader market. If Bitcoin takes one step forward, the rubber band stretches, and Bitmine has slingshotted 3 steps forward.
Amplifying the gains.
Right. But if Bitcoin trips and takes a step backward, Bitmine gets violently yanked backward. On March 26th, Bitcoin declined, and because of that high beta, Bitmine slid that 6%.
Which has to be incredibly frustrating for an investor. Management is building real revenue with Maven, but the stock chart still trades like a leveraged bet on Bitcoin's daily mood swings.
Analysts call this the double-edged sword of float velocity. Because the stock is so highly liquid, 1.2 billion in daily volume, it's hypersensitive to global sentiment. During a bull run, that velocity is your best friend. But during sell-offs, it creates severe downward pressure.
And that downward pressure exposes what I think is the primary structural risk here. We talked about how brilliant the NAV accretion loop is, issuing shares at a premium to buy Ethereum. But that mathematical loop only works in one direction, doesn't it?
That is the ultimate structural vulnerability. The entire strategy relies on the market paying a premium. The stock price must remain higher than the net asset value.
Because if the market panics, the stock price could fall below the underlying value of its treasury.
And if the stock price falls below NAV, the engine completely stalls. If management issues new shares at a discount to buy Ethereum, the strategy is no longer accretive. It becomes highly dilutive.
They'd be actively destroying shareholder value, a mathematical death spiral.
Exactly. To invest in this, you have to trust management to aggressively shut off the printing press during downturns.
It's a high wire tightrope walk. So, bring this all together for you listening. If you are evaluating the stock, you need a roadmap. What are the specific events and catalysts we need to watch over the next 3 to 12 months?
First, you have to watch their upcoming quarterly earnings. Look past the top-line revenue. You need a laser focus on one metric, their progress toward that alchemy of 5% target.
Right, the amount of Ethereum held per share.
Yes. You want to see continuous growth in that metric to prove the accretion engine is still creating value.
What's the second thing to watch?
The full operational revenue reporting for the Maven network. We know they have $6.5 billion staked, but the next few quarters will show us the actual profit margins and how much pure revenue is hitting the bottom line.
And then there is the massive macro catalyst, the one that feels completely out of Bitmine's control, the Clarity Act. Prediction markets give a 68% chance of it being signed into law in 2026.
The potential impact of the Clarity Act cannot be overstated. For a decade, regulatory ambiguity has suppressed digital asset valuations in the U.S. Traditional institutions like pension funds have deep pockets, but they won't invest without a clear legal framework.
So if the Clarity Act establishes those defined rules of the road,
It unlocks the gates. It would universally re-rate Ethereum assets across the board. For a company sitting on an $11 billion treasury, the multiplier effect would be unprecedented.
it would drive a massive wave of institutional capital directly into their stock, using that huge liquidity as a regulated proxy, which circles us perfectly back to their goal. They are sprinting to hoard 5% of this network specifically before that regulatory light switch flips.
It's an aggressive, unapologetic land grab. It really is the ultimate high beta play on the institutional financialization of digital assets.
We've covered the vault mechanics, the accretion loop, Maven, and the dilution risks. But I want to leave you with a final overarching thought to mull over today. Bitmine is executing flawlessly to own 5% of the entire global supply of Ethereum. But if they succeed, what does it mean for the foundational ethos of a decentralized financial network when a single publicly traded Wall Street entity holds that much of the world's supply? Does the network remain decentralized, or does it just recreate the exact same centralized power structures the technology was built to escape? Thank you for taking the time to join the conversation with us today. We always appreciate your time and your curiosity. Until next time, stay informed.